Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
So that broadly are three reasons why I am bearish.
And I guess, so what is my question? Not that I'm not doubting, but if that is the case, that you're bearish, where do you go? Because I think, as it has been pointed out, bonds aren't a great alternative. And we can talk in a minute about real estate. Is that a great alternative? Equities, we advise investors who have to be somewhere, and they have to at least keep pace with inflation. Or they're going to start losing. So where do you go?
It's not so much where you go, it's how you invest. And I think we have to learn the lessons back from the 70s. And I've been in the market for 43 years, but I learnt from people, and there were mainly men, I'm afraid, who worked in the 70s. And it was much more about not riding, just trying to ride beta. You had to be more nimble. You had to be prepared to invest in something and then take profits quicker. You put more focus on arbitrage. So basically, and there was probably more opportunities about alpha in those days because markets were less efficient for the reasons we were talking about earlier. So that comes back to the question I asked earlier about, will AI kind of make it even more difficult to get alpha? In which case you have to go to... Sorry. I think more difficult because everybody's going to have, question, but everybody's going to have AI somewhere on in their back. They're all going to be saying, I'm not saying the same thing, but very similar results. I think it's going to be quite difficult.
Yeah.
I'm just to riff on that a little bit and to your question. I think the other consequence of 40 years, 35, whatever it is that we've been through is, and I look at it through the lens of what asset owners are doing, more institutional than retail, I guess is my experience. But when I talk to asset owners all around the world, the really big sense I've had since I started my career to today is they're more passive than they've ever been. There is more in buy and hold fixed income than they've ever had, and there's more private assets and kind of illiquid assets than they've ever had, and their decision making is much more set and forget long term, even if they don't want it to be, by nature of those investments. And so I think understanding that as a starting point is really, I think, important, because I think for me that's a real explainer as to why I don't expect bonds to do well, not just the geopolitics, not just the inflation concerns or debt or otherwise. I think fixed income is what you sell in order to try and get some liquidity, especially if it doesn't offer you diversification at a portfolio level. And I think that's a big kind of pressure down on kind of bond prices, in my opinion. And then I think equities, it's not about in equities or out of equities, but I think there will be winners and losers. And I think index equities is what's likely to suffer. And so whether that's kind of whether that's alpha, whether that's more national winners and losers, whether that's kind of emerging markets or more developed, but a more active, targeted kind of approach to equities. I'm seeing a lot of asset owners who used to have very siloed approach to this starting to come together and kind of break down those walls to think more dynamically about allocating capital across those. And I think and that's kind of my final bit, that I think there's a governance kind of skill set uplift required, because a lot of those skills that might have sat in asset owners 25, 30 years ago isn't there today, to be more dynamic.
Right.
And to take more risk, to be more, to whether it's taking profits or hedges or otherwise. And so I guess I look at it through that lens too, and I think that's an important consequence of that.
I think the active side is important, but I think large Western companies, there is so much data on them, there's so much information that there is little value to additional research and to active management. And I don't think anyone's going to be able to outperform the AI within 12 months. Smaller companies where there is less information, there is less coverage, where there is frankly less thorough and complete management. If you're Alliance Boots and you need to hire someone in on AI, you go and get them. If you're a $50 million company, you might not be able to afford that person. So you're going to need someone who's going to help you.
Mm.
And that might be on the private equity side. All the leading managers are investing very heavily. I mean, JP Morgan across the bank and the asset management is investing hundreds of millions in AI. They're going to go in and they're going to help companies. So they're going to be investment banking advice to those companies, and they're going to help those companies. That's where you're going to be able to see potential brand performance.
Mhm.
So smaller companies, also developing markets. I